Thanks so much. Hi, everyone. So nice to have you here. And we are delighted to have this session with you to dive into how to build institutional grade crypto infrastructure. We have some of the longest standing Crypto Valley Association members, such as Ledger, and a bunch of new companies, Aplo, we have Kaiko, and we also have Talos joining us to share their viewpoints and also to just elaborate on the topic of today. What an exciting topic, but also what an exciting week in the history of crypto. And my name is Emi Lorincz, the CVA president. I have the honor to be the president since February this year. And the CVA's mission is really to foster collaboration among the members, be it corporate or be it institutional members. Let's kick this off and start with introducing the panelists. Please all introduce yourself and just share what your company does in the ecosystem. Lila, would you like to go ahead, please?
Sure. Hello, everyone. Thank you, Emi. And it's nice to be on this panel. I have to preface it. I feel like I need a big Ledger sign behind me. Everyone else has like some swag that they're rocking. So Lila Garcia, Global Head of Customer Success at Ledger, says the sign behind me. I've been with Ledger for about a year. Previously, I was working in traditional financial services at what's now called London Stock Exchange Group and Bloomberg. Ledger Enterprise is a global technology provider, really empowering organizations to participate in the digital asset ecosystem securely and at scale. We have a SaaS platform that delivers treasury management, DeFi, NFT, token creation capabilities with secure governance. Pleasure to be here tonight.
Thanks so much. Oliver, would you like to go ahead?
Sure. Thank you, Emi. Thank you for the invitation as well. I'm glad to be on this panel. So Oliver Yates, I'm the co-founder and CEO of Aplo. We're a French company that's about 3 years old, and we're a leading provider of prime brokerage services in the digital asset space in France, in the EU, but also globally. So we offer best-in-class services for trading, custody, lending, and we also offer some intelligence around, security management, reporting, and research.
Great. Thanks so much, Oliver. Great to have you. Bediss, would you like to go next?
Of course, thank you. So my name is Bediss. I've joined Kaiko 2 years ago. So Kaiko, it has been around since 2014. Personally, I've been in market infrastructure since I started working. So at Murex first, for trading system for traditional finance, and then I spent 6 years at Euronext building exchanges, literally, but traditional finance exchanges, before joining Kaiko and working on institutional grade financial infrastructure but for crypto.
Sounds like you've seen a lot. Thanks so much for joining and being here. Alfonse?
Hey everybody, my name is Alfonse Mandese. I'm head of sales and business development at Talos. Been at Talos for about 2 years. Prior to Talos was at Ledger Enterprise actually, and then prior to that, traditional capital markets, mostly in equities at Citigroup. Great to meet you all. I think just a little bit about Talos. So we are a single point of access to a network of institutional service providers. So we are a technology provider powering both buy-side and sell-side interactions with the street. And so those service providers include exchanges, OTCs, settlement networks, custodians, and lenders. And our goal is to really take both buy and sell side participants through the entire trade life cycle. And we can get into a little bit more of what that means later.
Thanks so much
for having me.
Yeah, we are so happy to have you here, all of you. And maybe let's dive a bit more into first, what is the USP of your companies, Lila and Oliver, if you can allude to that. How are you setting up the institutions you cater to or you serve? How are you setting them up for success?
Go ahead.
Sure. Thank you, Lila. I'm happy to start. So, for decades, investors have been using prime brokers to access multiple asset classes like equities or commodities or foreign exchange. And they do that because it just makes their life simpler and they can focus on the strategy. That's really the sole purpose of a prime brokerage, is to take care of all the low-level operations and the plumbing. And so if you look at the crypto space right now, If you look at funds, for example, they'll have to resort to using a bunch of different providers. It's pretty fragmented in order to build their own stack for investing. That can be quite time consuming. And so the idea with Aplo is that institutions can trust a single provider to take care of all of that, and make their lives easier. At the end of the day, it's the same purpose as traditional prime brokers. The method and the tooling is just different.
You're on mute, Emi.
I think you're on mute, Emi.
Thanks for giving me a sign, guys. So Oliver, besides how are you setting them up to success, also how are you making sure that their risks are managed, or how are you protecting them?
Absolutely. So that is true. It's one of our main jobs, and I didn't want to cover that one just because I don't want to enter into too much technical aspects, but there's two ways we mitigate counterparty risk for our customers. The first one is that we are a qualified custodian with the French SEC, the AMF. So whatever assets are in our custody, they're not on our balance sheet, which is quite relevant right now in the current set of events. And secondly, our customers are going to want to access multiple exchanges, venues, and execute through us. And at that point, the way we mitigate counterparty risk is that, first of all, we have a system that rebalances assets across all the venues and minimizes the amount of assets on said venues for any given customer. So it's less than if they were doing that on their own. The second aspect is, for some customers, we can also take the counterparty risk for them on those venues against the premium. And at that point, they don't even have to take care of any specific exchange. I hope that answers the question.
Yeah, absolutely. We can dive deeper into that towards the second part. Lila, what is the ultimate selling point of Ledger Enterprise? If you would be so kind to allude to that.
Yeah, so I mean, as we all can probably attest to, I think, we know that crypto institutions are complex, and whether you're an exchange, a custodian, an asset manager, or a corporation that's looking to launch a new NFT strategy, for example, or a corporation that's looking to manage treasury, the first concern should be security. And then scalability. So what we aim to do as a platform is allow companies to grow securely and then at scale, while also unlocking the larger crypto ecosystem.
Thanks so much. I'm interested to learn also that Alfonse and Bediss, your companies make it easy for businesses to tap into the potential of crypto. And Alfonse, how is Talos enabling their clients to succeed? And then I will ask the question to Bediss as well.
Sure. I think there's kind of two main pieces here. So really what we're trying to do is set a new standard for crypto trading. And that's what we sought out to do when we started the company. And so we have our roots in building high performance trading systems for both the buy side and the sell side in traditional markets across FX and equities. And really crypto is no different. We knew that there was a standard that we needed to reach in crypto when it comes to the feature set that you are used to, the workflows that we can adopt and adapt to, the general safety, performance, and reliability of these systems. And so the first step was very easy. It was thinking about things like liquidity aggregation, multi-dealer RFQ, building out algos, making sure we had really strong market data. But now there are things within the crypto ecosystem that we can do here that we couldn't do in traditional markets. And that's actually thinking about that full trade life cycle. So what can you do post-trade? You can actually hook into custodians and settlement networks. You can manage your working capital, and you can settle directly through the Talos platform. And really, the whole goal is to build the system from the ground up based off of what we learned in the past about how to build high performance systems, but also cater to kind of the nuances and idiosyncrasies that you may run into and the constraints you may run into in crypto around exchange pre-funding, obviously connecting over the internet, lack of standardization and reliability from some providers, though everyone generally is getting better. And so really we're trying to be this resilient and performant layer on top of that, and then cater to not only just buy side workflows, but also sell side workflows as well with a brokerage in a box solution that we're building out right now.
There's so much to unpack there. And I think, in later we can totally unpack a few points you mentioned. But this one, when we prepared for this, then you were saying that Kaiko caters in 4 ways to its clients. Can you please share which are these 4 ways?
Yeah, sure. So Kaiko, we're a data product, services, and solutions provider all along the different needs for the investment life cycle. And I think something worth mentioning is the trend that we have now in crypto in particular, but also in the whole traditional finance and fintech and all of that world is that tech and solutions, exactly what Talos is doing very well, is getting commoditized to a certain extent. Infrastructure is getting commoditized, and that's the whole blockchain thesis, right? So that makes the next level of difficulty being data in all of its aspects. And what we do in 4 ways, indeed, to ease the job of the whole ecosystem, including infrastructure providers and system providers all along the value chain, is first making sure that there is resilience and institutional grade market data services available across any type of exchanges, standardized and so on. So that's pure what we call CVA market data services. The second thing, when it comes to everything that happens on chain, there is a deep need there for data to be worked on in a very particular way, because there is a lot of business being done into network data, a lot about wallet data, a lot about follow. Like, there are incredible companies doing a good job at it, but what we saw and what we started doing is that you don't have the same venue level market data that you could have on centralized or traditional finance exchanges. So what we've been doing is literally extract ledger records that you have on chain and engineer market data out of that, which means we reverse engineer the protocol, we read the blockchain from inception, and we maintain this kind of real-time view and real-time tick level market data engineered out of the blockchain for all of the protocols that we cover. We're also looking into building Oracle solutions that can bridge what is available through Web3 oracles and so on in the on-chain level. The third way of easing the job of our clients is through quantitative solutions in the risk management world. So typically, if you look at traditional finance and you look at a Bitcoin-backed loan and so on, you need interest rate curves. You need a set of what is perceived as being extremely vanilla in traditional finance, but that doesn't exist to some extent, or not yet, in crypto. So we're heavily working on making that available and at scale and according to those standards for the crypto ecosystem. And the last piece is indices and reference rates, whereby for whether it is passive investment, whether it is benchmark, whether it is marking prices, pricing is as hard today, whatever the development that we've been through and all of the ecosystem has been through, as it was 5 years ago. When you end up with FTT tokens being priced the way they were priced, while there was literally no liquidity to absorb such a price on the market, that means that there is no proper mark to market, proper mark to model way and of determining fair value and so on. So that's everything that we're doing. And all of those matter, from trading, settlement, investment, research, backtesting, and all of those use cases that we don't address from a software solution infrastructure, which is what Talos is doing super well, for instance, and Aplo and other actors. We focus on the data.
It's so kind of you to help the pitch of your co-panelists, or as in to put in a good word and the recognition. So, like, I can imagine all the exciting data you were seeing on chain yesterday, or as in, I'm sure you were glued to the screens like many of us. The next question is really around the challenges and the main constraints when institutions come into the crypto world and they want to trade digital assets. Then what are the main adoption breaks according to you guys? What is holding institutions back to jump full in? Lila and Alfonse and whoever wants to
I can jump in on this one. I mean, I think breaking into crypto, there's multiple pieces that come with it. First, it's having the expertise, and then, the foundation. And with that, it's really choosing the right partners. So understanding how to select the right partners to ensure a smooth and pain-free operation. For example, we use Kaiko for our pricing and billing. I mean, in order to not only manage our own internal systems, but also to make sure that our clients are being priced accordingly, and that the rates that they're seeing on the data that they hold or the assets they store are in line with what we see. So it's important to have the right foundation, to choose the right partners, so then you can focus on your core business, which is whatever it may be, whether you're an exchange, a custodian, a corporate, etc. So I think that if you have the right foundation and the right infrastructure behind you, your operations are going to be much more easier, and you can focus on that core business with a much better mindset.
Yeah, pretty much enabling the institution to focus on what they are good at, and then yeah, freeing them up, freeing time up for them. Alfonse, anything else you would like to add? Thanks so much, Lila. Really good
Yeah,
point.
I mean, I totally agree on the partner selection side of things. I think in general, institutions come to us and they say, hey, I am trying to either launch new services in crypto that I previously launched in FX, equities, et cetera, or I'm trying to run a similar strategy from a buy side perspective, but do this in crypto. And there's just the basic questions of like, how the heck do I do this, right? I want to run this strategy across 100 coins. Which providers do I need to connect to actually get a breadth of coin support in order to run the strategy efficiently and have some redundancy and resiliency and diversity of counterparties. There's also the question around, how do I connect this to my existing systems, right? How do I get my InfoSec compliance and risk teams comfortable? And so a lot of this turns into this sort of education phase. And so, we're doing our best on our side to help educate those customers, and obviously to button ourselves up and hold ourselves to really high standards. And I think everyone on this panel is certainly doing the same, but that's like a key part of it, is finding those key partners and identifying the right ones to align yourself with and being pointed in the right direction. Because the reality is you'll likely need to interact with not just one or two, but maybe 4, 5, 6, 7 partners in the space to be successful.
Super, thanks so much. We have a question in the meantime from Garcia. By the way, we had over 200 signups, and then hopefully more people are joining along the way of during the session of today. And Garcia, we will answer your question live. So the question goes as following: if a crypto company or a TradeFi company approached to help to set up an offer to their clients, any kind of crypto products, what would be the main step? And I think now partially this question was answered because the working with the right partners, as in vendor selection. But what else should the TradeFi company consider? Of course, this is really depending on what they want to do, but
if I may jump in on this one, the first thing also that needs to be taken into account is the current macros beyond what happens in the crypto space. So TradFi are a lot looking into in innovating and entering the space for a lot of strategic reasons, but there is also a search for capital efficiency right now. So cost effective solutions are important. And I think that's where everything that was said about the right partnership and so on is being approached by TradFi through a horrid name, which is supplier risk management. And I think that is most probably the one angle that is the most important, because on the one hand, you cannot have real good sustainable suppliers like all the people on this panel, and at the same time looking for the cheapest and not sustainable actually acquisition of solutions and so on. So that's where today there is a balance that is being set, because at some point people have been onto a growth at all cost spree, which means growth at all costs means, okay, I'm going to go for having stuff for free. I'm going to cut prices. I'm going to do anything to acquire logos and ratify logos. But from a traditional finance institution point of view, that means that you're actually subsidizing the price and revenues to your capital investment from your VCs and for whoever has invested in the company, because at some point that has a cost. So growth at all costs becomes almost a race to the bottom. So that's where there needs to be work, and everything that we're doing and saying about partnership and so on, I think is the most important thing of this bear market, because at the end of the day, only the sustainable businesses and growth will make it.
And if I may just jump in, my very quick answer to what a TradFi institution should do if they want to set up a quick crypto offering for their customers is figure out whether they actually want to manipulate the crypto or not. There's really two approaches you can take. The first approach is whether you do it with providers or no, it's you actually have some role as a financial intermediary, in which case you're going to have to figure out a lot of things around regulation. And the other step is, well, I could just white label, somebody else, and that the offering might be less unique, but maybe it's quicker to market. And so I think that's like the main question is about strategy. That's the first step.
Super. I see everyone from the panelists were nodding, so I think there is a big agreement here with you, Oliver. And just to make the audience a bit more aware of really what Aplo does, and also how typically Ledger Enterprise operates, or who are the clients. Maybe you guys can give a bit more color before we move on to other questions, and specifically, which areas do your customers lack skills in?
Sure, I'm happy to start on this one as well. So at Aplo, we service institutions at every step of their journey into the crypto space. So that means that goes from novices right to the most experienced digital asset traders. So we'll have crypto native funds, trading firms, we'll have some fintechs, some traditional hedge funds, some alternative fund managers, banks, family offices. It's quite broad. And because it's broad, it means that the skills that they need, the skills where we kind of fit in, add some of the Lego bricks, it's super different between the different customers. So in some contexts, they'll really be looking to optimize one part of their whole process. That's generally the case with more sophisticated customers. And then you'll have other smaller size customers that will use us as their one-stop shop. And what they're looking for is essentially an operations team, where they're outsourced operations team. It's all automated. And then you'll have other customers who are really looking to us because what they're lacking is the regulatory know-how. And so they're trying to figure out how to set up their operations in a compliant way. And they know that by using us, there's that stamp of approval from the regulators. So it really depends on how advanced they are on their journey for digital assets. I'm fairly certain that the other people on the panel have had the same experience as well.
Yeah, I mean, I'll build off of that. I think that it's hard to pinpoint a skill that's lacking. I'm not sure that that's fair to say. And if there's any clients on the call, you're perfectly skilled, skill set. I think, but it goes back to what Oliver was saying, and also what Alfonse was saying a little bit earlier. A lot of the time, there's an educational gap. Our clients at Ledger Enterprise, we have exchanges, custodians, corporations, miners, OTC desks, trading platforms. We have really crypto native, so deep tech guys, and then we also have novices that, we have corporations launching NFT strategies that, people have literally like Web3 for dummies next to their laptops. So there is an educational gap in terms of understanding what strategy they want to implement, and then how to best do it and best practices within the industry. So, what we try to solve for is replicate what we see other clients that have been successful doing, and share that knowledge with new clients that we bring on, or new clients that we're talking to, explaining how to best put forth some of these strategies. And then, of course, I think when we're speaking to prospects and or new clients, often we find out that they don't understand their own pain points. They're not able to identify the gaps in their business. For example, security is a very complex topic, and a lot of clients, or particularly large organizations don't have the luxury of spending too much time, or even, you know, small organizations to that matter, don't have the luxury of spending too much time on figuring out the intricacies of, you know, what security actually means. And so it's important to take the approach from, you know, our standpoint to educate them on, you know, what they're doing currently, where the gaps are in their current business model, and then try and solve for those, hopefully solve for those gaps.
At
Great.
the end of the day, the little sister, the little brother of security, like Lila said, is risk management. And essentially what Ledger has been doing and being super vocal on for the past years is risk and be careful and know your risk and everything. And that's the whole risk management. We've seen that in the May cycle. Now, same. It's all about risk management that everybody needs to step up our game.
Not your keys, not your coins. This never gets old, right? Crypto one-on-one, but it applies. Cool. So maybe before we take a question from the audience, then you guys alluded a bit to the buy versus build. So institutions shouldn't try to build internally the infrastructure, because there are so many well-equipped and adequate providers who really help you spare time and add so much expertise to what you're trying to do. So because crypto has so many layers of complexity, what is your main argumentation for the buy case versus the build case?
Yeah, I can take that. So I guess my view would be focus on your alpha and your expertise. So if your alpha comes from being the fastest to the exchange and you're a high frequency trader, for example, build that connectivity. That's going to be your edge. But if your alpha comes from a service you provide or your distribution channels or from a specific strategy that you run, then outsource the commoditized things, because actually the commoditized things in traditional markets are even more complex and difficult to build and maintain in crypto. So let us deal with the headaches, the APIs, the connectivity, the GUIs. And then the last thing is really just around kind of what are your timelines? If you want that easy, fast path to market, buying is always going to be your sort of best approach. I mean, for us, you know, we're onboarding buy and sell side clients every day. We have clients on the buy side that sign and are up and trading within days, and on the sell side that are up and offering brokerage services to their clients sort of in a riskless principal fashion over API or over GUI within weeks in some cases. So that's also a consideration to definitely think about.
If I may add on this, so from our very narrow experience at Aplo, what we've been noticing is that at this stage, sell side, like big sell side firms, you know, like big banks or very big brokers, they're not even trying to rebuild the whole thing themselves, but they're mainly going to be shopping for multiple vendors and building some kind of big like internal solution with multiple vendors so that they have redundancy. And that's what I've been noticing so far. And then on the other hand, you look at like smaller sell side or any type of buy side, to be honest. And at this stage, they're really going more towards the buy option. And that's what we generally advertise, because sell side's alpha, as you were putting it, Alfonse, might come from, you know, how different their own service is. But on the buy side, it's not about service, it's not about infrastructure, it's purely about their investment strategy. So 2-3 years ago, some of them were saying, well, we're going to build our own stuff. At this stage, this doesn't even seem to be an option anymore.
Super, Tim. Thanks so much for chiming in there, Oliver. Do we have questions from the audience? Please feel free to, you can also just raise your hand and we will unmute you and you can ask your question live if you wish. Otherwise, we will just move on and we really can't have a conversation about institutional crypto adoption without just unpacking a bit what happened yesterday. And touch base on that, but Bediss, before there is a question for you, I will read it out loud. Can you please, Bediss, elaborate on the risk management capabilities at Kaiko? Do they revolve around TradeFi techniques or are they more on-chain specific?
So what we do, for instance, at Kaiko, and is literally put all the solutions and practice around risk management in portfolio and so on available as a service for anyone and any kind of client persona. If we take an example, for instance, on the liquidity crunch that happened, not the recent one, but the one that happened earlier in the year, that's a very basic absence of cash to compensate for volatility and for movement of the markets. In very classic way of managing it at a vanilla level, that's called value at risk. So you know the movements of your portfolio, you have a level of volatility that is associated to it, and you're going to bundle and provision an amount of cash to compensate for that. If we look at currently traditional finance, the whole clearing is migrating now, today, in equities, stocks, and so on, from pure valuation to value at risk model at clearing level. So it's literally extremely classic, and that's the thing that doesn't exist at all currently, or is not deployed at scale in crypto in the very post-processing. I'm not talking about investment strategy, I'm talking about middle office, back office, of saying, okay, we need to have risk management policies associated to those. So what we are doing on a daily basis is putting out there the solution that, okay, you don't want to build a value at risk model, then you have a solution that actually, to even if you don't want to act on it now, measure it and look at it. And it's the same when it comes to impairment clause, it's the same when it comes to implied volatility and pricing options, it's the same. And implied volatility can also be used as a monetization tool, by the way, because you can monetize implied volatility, and it can also be used as all of these tools and data, because we look at it from a data perspective. All of these are extremely classic when it comes to traditional finance and are at their inception in the crypto ecosystem.
Thanks so much, Amit. I think your question was answered, so I will just mark it as answered. And Hillary has a question: how do you approach the uncertainty around institutional trust in the space, considering the events that have transpired over the past few days and months? And will the trust from institutions be gone after yesterday? What do you guys think? What is what we can do better and make sure that this doesn't repeat itself?
I can jump in on this one. I mean, I think, people have a legitimate reason to worry, and if one of the largest centralized exchanges ends up in financial difficulties, then you have to think about, where does your money lie? With whom. And I think that, we go back to what we said just in the beginning, not your keys, not your crypto. That's, on the retail side, of course, we saw the sales of Ledger Nanos, triple in the past couple of days because of what unfolded. So great for the retail investor, or for us, because that's an educational piece. You have to be aware of where your money actually sits. And then on the institutional side, you also have to be cognizant of, how is that money being managed? At Ledger, we have, we say security at scale. So the idea is making sure that there's governance in place to ensure that there's no single point of failure, and that when those transactions are happening, no matter what size, there are the right triggers in place to ensure that they can and should happen. So I think it's important that when you look from an institutional standpoint, how the money is being transacted, where it's going, who's signing off on it, and making sure that where it sits is in a secure place that is not subject to, either market manipulation, as we saw earlier this year, or, fall victim to a centralized body, in financial difficulties. So it's really important to do your due diligence and make sure you understand exactly where your money sits.
Thanks so much, Lila. Someone else wants to chime in, or is there something to add? Maybe Oliver.
Absolutely. I mean, if you look at traditional finance, it's unsurprising to see consolidation in the exchange space. You probably end up with like one major exchange, and then like a second with like 30% of the market share, and then a contender that's coming up with 10%. That's what you got in the States, for example. Now, it came as a surprise that FTX, failed the way they did. Came as a surprise for everyone. I mean, we've been monitoring the situation for a few days at Aplo, but still, 2 weeks ago, 3 weeks ago, harder to tell. And this will just likely speed up the pace of regulation, which in turn will reassure institutional investors. I mean, the FTX situation, sure, institutional investors will probably not try to use FTX or even Binance more after this, who knows, but regulation is always positive for these types of players. So that's our take.
Yeah, and just to add on that, I think, there are a ton of providers out here doing things right, buttoning themselves up from a risk management standpoint. I think with sped up regulation, like Oliver, you're mentioning, we will also see a lot of the larger traditional players potentially use this and view this as an opportunity to come in. They have great reputations. They have built these services at the highest standard and scale historically, and I think they have an opportunity to come in and take market share. And we've anecdotally been working with a few of them to help them build services. I think most of them view this as an opportunity. At the same time, this doesn't mean that there aren't high quality incumbent providers that will also continue to gain share from this as well, and benefit from this. And I think it's, again, going to be a gravitation towards those highest quality service providers, but also maybe some additional diversification of how you think about your counterparty risks. So maybe if you were coming into the space and thinking about trading with one or two players, maybe now it's 3 or 4, and it just factors into those risk management decisions.
Thanks so much for chiming in, Alfonse, and really good points across the board from everyone. Thanks so much. So the next question is that since the company you represent was founded and you have been working with all these various capital markets players or FX trading companies, what are the major lessons you and the founders of the company learned along the way working with these institutions? I know that some of the points may be the ones which were already mentioned, but yeah, if something else comes to mind, that what did you learn along the years with dealing traditional financial institutions, then it's great if you can add or share.
Happy to chime in briefly. I think touched on this a little bit, but I think a key lesson that we learned is you can't just jam a traditional system into crypto. So take an FX system, for example. We come from building these high performance FX systems. We realized that you kind of needed to build this from the ground up to really make sure it's performant, can kind of handle a lot of the new challenges of crypto, right? There's precision that's vastly different. The symbology is different and not standardized. There's this whole notion of exchange fees in crypto, and sometimes exchanges are charging fees in dollars. Other times they're charging in crypto, and it just creates a whole host of kind of headaches. And I think it's also, don't underestimate sort of the time that it would take to build these systems and to do it really right at the highest standards of security. The same goes for custody. I mean, we learned this ourselves. I think if you asked our CTO how long it would have taken to build Talos when he first started, he probably would have said maybe 9 months or a year. I think it took us maybe 2 before we were really comfortable letting institutions interact with it, because we didn't feel like it truly met the same standards that they would grow accustomed to, that had grown accustomed to. So I think these are all just considerations. There's just a lot more behind the scenes that needs to be tackled, though the industry is definitely getting better and from a technology perspective, more reliable for sure.
Yeah, I'd also add on top of that, I agree completely with Alfonse. I think that a lot of these TradFi companies move into the crypto space and they come with their in-house infrastructure and they attempt to sort of replicate what they've done and then move it into the crypto space. And it's very difficult. I mean, particularly with these large players, and even to what Oliver was saying before, on the sell side, you have like, a conglomerate of providers or in-house solutions, which can become a beautiful mess. And then maintaining the in-house solution that you've built for the TradFi space and scaling it to crypto is really difficult. And on top of that, you're subject to much more regulation when you come in, from a different standpoint. So I think, that causes them to be less nimble and building solutions and building new offerings. So I think that, I consider it a little bit of like this slow and steady burn when you see these big TradFi guys moving into crypto, particularly expecting that they can use what they've already built and replicate it in what is seemingly a similar industry, but not quite.
Yeah, and to piggyback on this, I think the very, very good thing that could chime out of these conversions is the fact that indeed, when you look at the market, crypto and TradFi and so on, 80% of what is in TradFi could apply to crypto and so on. However, the 20%, remaining 20% are structurally different. So Ledger knows that through the custody, like nothing to be compared with. We know that through the data, because essentially when we've designed our implied volatility model, well, the first thing you look at is how much crypto is going to break FX and equity models, and it does break it very well. So you can't just take crypto markets and try to use an FX on an equity model to just try to model the market. And I'm pretty sure Alfonse and Olivier will have similar examples happening in their own fields. So that 20%, however, needs also to be compensated by the fact that, and the form of recognition that TradFi will come with a certain level of standard. And that level of standard, whether it is through technical standards, whether it is through regulation, because regulation is nothing else but an enforced standard, and that level of standards in service, SLAs, data, trading systems, compliance, risk management policies, and so on, that will actually help to some extent, because yes, there are people, businesses, and individuals, groups being hurt by what is happening in the absence of standards as well.
If I may add a last point in terms of what we've observed, our lessons from trying to work with institutions along the years, it all boils down to one essential piece of capital markets called clearinghouse. The mere fact that there is no clearinghouse in crypto makes every single discussion about crypto tooling and infrastructure very difficult to have, because we're not speaking the same language. All the rules that exist in the equity space or even the FX space, they all exist because there are very big entities that are willing to take the counterparty risk for everyone. This is not the case in crypto. So when TradFi institutions would come to you and ask, oh, so you're a broker, okay, so where's my custodian, and then how do you connect to the clearinghouse? You're like, well, what clearinghouse? The clearinghouse it's Binance or it's us, and there's no choice. So that was a lot of education around this.
And if I may, it's most probably the most structural point, what Oliver just said. Like, I come from an exchange and did the whole thing back in traditional finance. And people tend to mix between technical and business in the topic of clearing and T+1, T+2, and so on. What exists in traditional finance, which is funding trades after they're executed, whether it's T+2, 1 after 6 hours, whatever the model, comes from a business reason and not a technical limitation. It comes from the idea of being able to deploy capital and mobilizing it after the fact. So decorrelation of deployment of capital and mobilization of capital. When you pre-fund, you have to mobilize the capital before you deploy it. And that is the 100% business, structural business difference between crypto and traditional markets. And that is something that often when I look at the topic, people say, okay, it's just because it's all system in traditional finance and that's it, they can't do intraday settlement or atomic settlement. No, it's not that they don't want to or whatever. It's a real business infrastructure, market logic that has been implemented for XYZ reason. Now, if it's a good or bad, I'm not opinionated on the topic, but it's important. And that drives, of the 20% of difference, that's maybe 60% of it.
Yeah, thanks so much. Super good insights here. And now we looked into the past. If we look into the future, then how are you making it more attractive for clients to work with you? So when it comes to addressing yield generation, then Ledger Enterprise has a great offering when it comes to staking and DeFi, but also curious how Kaiko is addressing quantitative analytics and DeFi. So Lila, you want to take it away?
Yeah, sure. I mean, the way that we're looking at it right now is simply that we're just leaning in. We are really approaching yield and DeFi strategies as the what's going to define our next year. And from an enterprise standpoint, what our clients are most looking for. It's that passive yield generation or that passive income, and then the ability to access and unlock new strategies that they're interested in diving into. So, by end of year, we will have launched staking on 5 new protocols. We're adding an entire DApp suite into the Ledger Enterprise platform. And we're really going to, open up the ecosystem directly through our SaaS platform, which we think is going to change the way our clients not only use us, but then can interact with the ecosystem. And I think that, when we look at yield and DeFi, it's all about, one, different customer profile types. Is this strategy right for me? Is this strategy right now? And the idea is to make it accessible for them when the time is right, and to make sure that they can simply generate yield off of the relatively large positions that they have on those proof of stake and or potentially DeFi capable protocols.
Super, thanks so much. Bediss, do you want to give the viewpoint of Kaiko, and how are you guys addressing DeFi? What products are you building in order to be able to monitor the evolution of DeFi more?
When it comes to DeFi, the stance we've taken is really around bridging, and bridging by the data, not necessarily bridging technically and so on. Why? Because if you look today, okay, you're going to look at Coinbase, you're going to have all the books, trades, and so on. You're going to build your stack onto that. It's a lot more difficult when it comes to decentralized venues. And I call them venues because we don't know exactly yet what they'll become in the short, mid, long term, but they are venues to some extent. And those venues, currently, we need not to forget the roots of this. Blockchain is a ledger. So registry. So what you have are records of individual and contextualized events. So if you want to build proper market data that can be used in backtesting and so on, there is a piece of work that needs to be done to take those records and make and output market data out of that. And that's what we do. So that's how we off-ramp data from the blockchain in a market data way, so that tomorrow you can consume, use Coinbase, centralized exchanges, decentralized venues, market data exactly the same way. Obviously, market microstructure is not exactly the same, so there are differences and in the way, but that is represented in a way that as much as we can, we make it fungible. That's one. And the second piece is the other way around. If we want to have more resilient DeFi tomorrow, and there are a lot of people and working a lot on the topic and successfully so far, even if it's not making waves yet, but that is most probably the future. There's in the tokenization space, and what I mean in the tokenization space, it's not like issuing from one day to the other equity tokens, so security tokens and so on at scale, because we know that will take time. But you have a lot of player tokenizing existing securities, such as Bakkt, such as all of the other actors doing that. What they enable through then decentralized protocols such as Maker and so on, they enable to have a tokenized version of collateral, the tokenized version of assets that enables to really build DeFi at some point at scale when they'll scale. So with proper tokenized securities, real estate, everything you can imagine, and including, by the way, that's exactly what NFT, art, etc. have the potential to do with the additional fractionalization feature to it. So all of this is the very big trend, but to be able to do that, you need to price these, to value these, and to find a way to have data, making sure that all of this is interoperable technically from a software perspective, but also from a value perspective, and that means data. And when you look at traditional finance, well, venues are concentrated, exactly like Oliver said earlier. There is no 100 prices for the total stock. It trades on one exchange, and you're going to take the price from there, and that's it. Which is why data is heavily monetized, and that comes from a reason. So we need to find a way to bridge that world, which is the complete opposite of what we have, open source, open data, and the whole world of Web3, but enable DeFi Web3 with proper data solutions that are compatible with both worlds. And that's not an easy task.
Yeah, rightfully so. It's not an easy task, but we get there. I'm optimistic here, and maybe we can take Cyril's question from the audience, because he's curious to know which institutions do you see getting active in crypto? Is it only financial players like banks and funds, or do you also start to see corporates, treasury teams? And I think, Lila, you can allude to this, that it's not only financial players, but we see a bunch of other actors coming into the ecosystem.
Yeah, I mean, we we have seen a large influx of corporations come into the crypto space. One, from a treasury management standpoint, corporates that are now accepting Bitcoin and or Ethereum or other crypto in forms of payment. So, they're looking to make sure that their digital assets are secure and manage their treasury that way, and they'll come to us for support. And then on top of that, from the corporate, NFT standpoint, a lot of companies, as you guys see, I mean, it's hard to miss in the news. You see, Lionel Messi signing a deal here, and whichever other pro athlete signing a deal there. I think Lionel Messi was the last one I saw in my news. But there's pro athletes. There are brands. There are so many people, organizations, companies entering into the Web3 space, in the NFT space, particularly for either branding, marketing, strategy. And so, crypto, I wouldn't say is simply for the institutions as we think of them, banks, exchanges, custodians, trading platforms, etc. But the Web3 adoption is coming much more globally, and it's wild to see the adoption, but fairly exciting.
Thanks so much, and I think this answers a bit Ben's question as well. That what do decentralized exchanges and NFTs play, or what are the role they playing in today's world and the foreseeable future? And NFTs definitely have been playing a massive role in speeding up adoption. And I would love to take the last question, as Joy's question, as a closing question. But before that, I have a question to you all, a sort of a closing question. But yeah, like this one, that especially in the bear market now, what is what you guys pay attention to? And also, what is what you're excited about when it comes to your roadmap? What is what you think it's going to be a really big success, and yeah, just you're super excited about, makes your blood boil, if you can share that. Is there something what you're all looking forward to? Maybe we can start with Oliver, and then Alfonse, Lila, Bediss.
Sure, absolutely. I mean, in our case, look at the dot-com bubble. After that, a bunch of really great businesses were built, and this sounds like a very generic statement, but it's still what we believe. Now is the time to build. Now is the time to try to replace a financial system that revolves a lot on greed and biased decisions, and in some cases, things are not super equitable. So this is the right time to do it.
Thank you.
Yeah, totally agree with that comment. I think over the past couple of months, we've seen some of our best months ever in terms of new account growth. Now, naturally, we're in a risk-off environment, and we've seen some slowdowns in buy-side volumes, but the service providers are truly here and truly building, and I'm sure many here on this panel can echo that and confirm that. And really, they're building to usher in kind of the next wave of institutions, and so that's what makes me most excited and most positive about the outlook. And who knows how long a downturn will last, but I'm confident that when we do come out of it, we'll come out of it stronger and with really the high quality providers that we need to usher in this next wave.
Thanks very much.
Yeah, I mean, I'll echo the two guys before me. I think, focus on core business, keep your head down, focus on building. That's certainly what we're doing at Ledger. And then, as global head of customer success, I'm of course going to say, reach out to your clients, be there to support them, partner with them, build with them. You'll be stronger together when the bull run comes.
Great.
And honestly, as head of product, I think the Lila, Oliver, and Alfonse would agree. It's not the very big flashy announcement that actually can make you excited. And what I'm excited about is all the tiny little things that actually make sure that whenever you grow in a sustainable fashion. I'm extremely happy to see that on the block dashboard, you end up with data graphs that are empowered by Kaiko, built up by Talos, and that ends up on the block data dashboards. And those are very little success stories. And that is what we need to showcase a lot more, rather than the very painful and toxic, extremely hard competition that actually will not serve the market. And honestly, it's our third crypto winter. We've been through two already. This is the third, and same for Ledger. And people need to start listening on the fact that if we want this market and ecosystem to grow, trying to grow too fast and the practices of the race to the bottom and so on, or growth at all costs, whatever you name it, it's two names for the same thing, those are not going to fly.
You guys are also optimistic, and thanks so much, Bediss, when you're mentioning the little things. It's also a little success that you guys dedicated time today to share your viewpoints and also share your knowledge with the CVA community. So thanks so much for that, and kept this bit provocative but playful question of joy for the last part. He's saying that he believes that we are set back 5 years, given this week's event that changed my mind. I will also chime in. I think every time something like this happens, like if you think about Mt. Gox, or if you think about Luna, we always learned something, and we can incorporate these learnings into the future. And Churchill said once, or Churchill used to say that never miss a good crisis. So that's what Binance did here in a way. But yeah, curious to see how you guys would change Joy's mind.
If I may,
Sure.
right now, sure, we're really focused on the news, and so everything seems to revolve around a few big entities for crypto. But let's not forget, this all started from like some dude buying pizza with a lot of Bitcoin, and we got to where we are now from something that has nothing to do with exchanges or financial infrastructure. So I don't know if there is a place for everyone who's building stuff in the crypto space right now, but for sure, as the concept in itself has been so useful until today that it a lot of good projects were born, and so a lot of new good projects will be born that are not exchanges, not brokers, not financial providers, but just other things.
Gorgeous. Thanks so much, Oliver.
And if Bitcoin price went back 5 years ago, which is kind of the case today, that doesn't mean that the ecosystem went 5 years ago. And there is a big difference between price and value, and people tend to forget about that. There is value that is not always priced in, and there is a very, very large difference between the ecosystem today and the ecosystem 5 years ago.
Spot on. Difference between price and value. Yeah, that is something to.
Yeah, I mean, to echo that, if you go back 5 years ago, none of our companies existed really. I mean, I think Ledger, the B2C side did, but Ledger Enterprise certainly didn't. So if you set us back 5 years ago, none of us would be here. So I think Bediss is completely correct. I mean, the infrastructure, the ecosystem that has been built, you certainly can't go back to 5 years ago. That's not fair. We wouldn't be here if that was the case. But on top of that, I'd add, it's more important now than ever to, make sure that you're doing your research, you're diversifying, and that your assets are secure, more than ever now today, especially given the complex ecosystem.
Spot on. Thanks so much. Anyone else has anything to add? We were so efficient with the time. Thank you for the great insights also from Mark, and I would love to put my hands together to all of you, Lila, Alfonse, Oliver, Bediss. This has been amazing, and thanks so much for your time. See you soon.
Thank you.
Thanks for having us.
Thanks for having us. Bye.
Bye
Thanks.
for now.
Bye-bye.
Merci.